Welcome back to The Explainer. I am absolutely thrilled you're joining us today because, well, we are going to look at one of the most fascinating market stories unfolding right now. I mean, think about it. We are taking a legacy earth-moving giant, a company you probably instantly associate with yellow bulldozers and massive mining equipment, and we're analyzing it through, of all things, the highly unexpected lens of artificial intelligence. It's wild, right? We're going to peel back the layers of this narrative together, look at the actual hard data, and figure out what is really driving this historic company forward today. It sounds almost like a paradox, doesn't it? If I asked you to name the top AI stocks right now, you likely list off all the famous Silicon Valley tech titans. But lately, Caterpillar has actually been behaving like one of them, experiencing this massive AI-driven stock rally that has seen its shares climb over 50% year-to-date at certain points. The tension here is palpable. How does a century-old industrial manufacturing business suddenly find itself riding the crest of the digital AI wave? Is this a sustainable new reality, or just a whole lot of market exuberance? Okay, let's dive into this. Here is our roadmap. We'll start with the unexpected AI play and powering data centers, then pivot to valuation and industry cyclicality. Finally, we'll check the balance sheet's margins and debt and look ahead to their 2030 autonomous targets. Section 1. The unexpected AI play. To really understand Caterpillar's sudden tech-adjacent status, we have to look at the hyperscalers, the massive big tech companies that are currently building out the cloud and AI infrastructure. These guys are in an absolute global sprint. By 2026, they are projected to spend a staggering $600 billion in capitalized investments on AI infrastructure. Think about that number. And a massive chunk of that money, it's going directly into building giant, hyper-dense data centers. Now, you can't run a data center on just code and algorithms, right? You run it on physical infrastructure. And the numbers prove this isn't just empty hype. In the first quarter of 2026, Caterpillar's power generation subsegment saw a massive 41% surge in revenue. And honestly, this isn't some one-off fluke. Throughout the previous year, we saw this exact subsegment consistently post revenue growth of 28%, 31%, and even 44% in successive quarters. The AI demand is already showing up on Caterpillar's top line in a huge, undeniable way. Section 2. Powering the data centers. So what exactly is Caterpillar selling to these tech titans? Well, it boils down to the absolute fundamental requirement of the AI revolution, electricity. These new AI data centers consume unimaginable quantities of power. To put it into perspective, by 2027, a single rack of AI servers could consume as much electricity as 65 households. Because of this massive pull, data centers need power systems that are continuous, instantly responsive, and basically bulletproof. Even a few seconds of a blackout can cost a big tech firm literally millions of dollars in lost processing. And this brings us to what analysts are calling the energy bottleneck. Here is the reality on the ground right now. Getting a massive new data center connected to the traditional public power grid takes anywhere from 5 to 7 years. But the tech giants, they're building these data centers in under 2 years. They simply cannot afford to wait half a decade for the grid to catch up. So, to solve their immediate power needs, they are buying up Caterpillar's massive industrial diesel and gas generators, as well as those large reciprocating engines to power these digital campuses directly or to act as massive backup systems. Section 3. Valuation versus industry cyclicality. Let's see what happens when we validate this AI growth, but balance it against the core business. Now, what's really interesting about this slide is the historical context. Yes, the growth in the power generation segment is incredibly exciting, and it's very real. But as discerning investors, we have to step back and look at the whole picture. Let's not forget, Caterpillar is a conglomerate. Beyond power generation, its core businesses, construction industries, and resource industries, which covers all that mining and heavy infrastructure stuff, remain highly cyclical. They are deeply tied to global commodity prices, interest rates, and construction trends. Notice the value line data here. Historically, as a cyclical industrial stock, Caterpillar trades at pretty modest multiples. But recently, mostly driven by this whole AI narrative, its PE ratio actually spiked to over 40 times earnings, with forward estimates sitting around 36 times. Its price-to-sales ratio also jumped way above the sector median. So it really forces us to ask the hard question. Is the market pricing in a permanent structural change here, or has Wall Street just given a cyclical industrial stock a shiny, expensive new AI paint job? And that premium valuation brings us to the biggest risk on the horizon. The huge capital expenditures from cloud giants like Meta, Microsoft, Amazon, and Alphabet are absorbing a massive amount of their cash. Right now, they are using roughly 72% of their operating cash flow on capital expenditures, and some estimates project that could push past 90% in the coming years. But here's the catch. If these tech giants decide the AI returns just aren't materializing fast enough and they suddenly slam the brakes on this massive cash burn, the demand for Caterpillar's power systems could dry up very, very quickly. Section 4, Margins, Debt, and Stability. Let's strip away the AI story entirely for a second and just check the actual balance sheet. When you look past the flashy headlines, you get a much clearer picture of the company's true health and stability as an investment. And this brilliantly illustrates the underlying operational strength of the business. Look at the steady, projected upward climb of their operating margins. We are moving from 21.9% in 2025, with expectations to hit 23.5% in 2026, and projections pointing toward 25.5% as we look further out to the 2029-2031 window. This tells us that Caterpillar isn't just growing revenue. They are becoming increasingly efficient and profitable in how they generate that revenue, effectively managing things like tariffs and elevated investments in new tech. Now, we have got to address the elephant in the room: debt. Caterpillar currently carries $30.7 billion in long-term debt. Standing alone, yeah, that sounds like a totally daunting number, but we absolutely must contextualize it. If we take their projected cash flow of $24.21 per share and we multiply that by their roughly 465 million outstanding shares, we see that they generate about $11.2 billion in actual cash flow. When you compare those two numbers side by side, you get a highly stable ratio of roughly 2.7 times. Basically, they generate more than enough cash to comfortably service their obligations. And because of that incredibly robust cash flow coverage, a strong backlog of orders hitting a record $51 billion, and that disciplined operational efficiency we just talked about, Value Line awards Caterpillar their highest possible mark, an A+ for financial strength. Even if the AI spending slows down or the construction cycle cools off for a bit, the underlying financial foundation of this company is basically built like a fortress. Section 5, Autonomous Targets for 2030. Let's move to and see how this builds into the next decade. Pulling back from those current quarterly financials and the immediate data center boom, let's see the bigger picture. Caterpillar has set some massive, genuinely transformative technological horizons for the end of this decade. They aren't just sitting back reacting to AI. They are actively integrating advanced technology right into their core heavy machinery business. By 2030, Caterpillar plans to triple the number of autonomous hauling trucks operating out in the field. That is growing from the 690 they reported in 2025. They are heavily accelerating the adoption of this autonomous tech, especially in quarries and mining operations, where absolute efficiency and continuous nonstop operation are just paramount. On top of that, by expanding their connected fleet to over 1.6 million units with newer technologies, they are targeting a massive $30 billion in high-margin services revenue by the end of the decade. These are tangible, highly attainable goals that extend way beyond just powering data centers. So, the crucial point is balancing these two realities. On one side of the scale, you have this incredible, proven growth in the power generation segment acting as a vital energy catalyst for the global AI build-out, all supported by a fortress-like A+ balance sheet. But on the other side, you have the undeniable reality of a historically cyclical business currently trading at near-record premium multiples, deeply exposed to the high capital expenditure risks of just a handful of massive tech hyperscalers. This is the million-dollar question for anyone looking at this stock today. Do the 2030 autonomous targets and AI catalysts actually justify the current premium? Has Caterpillar permanently leveled up into a premium industrial tech hybrid, or is this just a cyclical peak painted over with a lot of AI enthusiasm? Well, armed with an understanding of their true operating margins, their debt stability, and the fascinating reality of that energy bottleneck, you now have the tools to evaluate the stock's true worth on your own. Thank you so much for joining me on this deep dive. Keep questioning the narratives, and I will see you on the next explainer.